Right, well, shall we get this thing started? Thank you one and all again for joining us for another installment of a global liquidity update from Michael. I shall now hand over to Michael. So over to you, Michael.
Good, thank you. Good afternoon, good morning, wherever people are. What I'd like to do is to go through some of our latest slides, which I'll do in one moment. But I'm going to speak for probably about 30-40 minutes, and then we'll take some questions if you have any. What I'm going to do is to concentrate on latest developments in liquidity. The numbers that we're showing data, pretty recent data. Everything is up to the end of March. There's some very up-to-date data which basically take us to about 2 days ago on some of the latest evidence in terms of risk appetite, liquidity flow, and economic activity. What I'm going to do is to put some slides up, and hopefully we can get there. Great. Okay. Now, in terms of the main points, essentially what we're saying is that coronavirus probably obviously is just the trigger for GFC2. It's pretty much the equivalent of what happened in the Lehman crisis in GFC1. It wasn't the cause, but it was clearly an important trigger. And what we've been arguing for some long time now is that the world financial system has been operating with low liquidity safety margins. And the little diagram on the right-hand side is a way of trying to understand that. And what you've got is a liquidity cycle. That cycle, as we've argued for years now, is a highly cyclical movement of liquidity. The system has become more pro-cyclical over time, and that's largely because we've got liquidity creation coming from more and more sources of collateral. It's not really coming from banks, it's coming increasingly from wholesale money markets where collateral is important. And what it does is it leads to big swings. Those swings are exaggerated by cross-border flows, and it basically characterizes the global liquidity cycle. However, on top of that, you can see a dotted line, which we basically refer to as the minimum level of liquidity that's required by the system for debt rollover. And although in principle there shouldn't be anything necessarily wrong with debt, providing that debt is productive debt, which clearly there's maybe a question mark over. But the real issue is whether there is the balance sheet available to roll the debt over. And as we say here, if you've got $300 trillion of debt worldwide, which is the current total, that clearly is expanding rapidly this year. With a 5-year average duration of the debt, that means about 60 trillion of debt has to be rolled over each year, which requires balance sheet, and liquidity is balance sheet. The austerity and low interest rate policies that central banks and policymakers have enacted since GFC1 actually further adds to the problem because it cuts liquidity and it increases the amount of private debt, both directly through austerity processes, but also equally because low interest rates encourage more debt takeoff. The central bank response to the coronavirus crisis is huge, particularly by the Federal Reserve. That's something that we keep emphasizing. These numbers are just almost out of sight. And what you're going to be seeing in all likelihood this year is something like a 40% rise in global liquidity. We've never seen anything like that really before. The nearest we got was probably back in around 1986-87, prior to the global stock market crash, when liquidity zoomed up enormously in the wake of the Lehman Plaza Accords. The key event this time around is not just the alacrity with which the US have actually moved. They obviously learned a lot of their fire drill in GFC1, and they're using that to good effect, but it's actually the pointed increase in swap lines. And it's something that I mentioned on a call we had yesterday talking about my Capital Wars book, which was these swap lines are critical in terms of understanding the way that the world of 15 countries, which basically now have extended access to US dollars through their central banks, basically is the equivalent of NATO in economic world. NATO clearly a military arrangement that was an attempt to contain the Soviet Union in the from the late 1940s onwards through to date, very successfully. what we're getting here is an economic grouping that is outside of traditional supranational institutions like the IMF. It's organized by the US, it's basically directed at friends, and it enables them to get access to dollars. So what this is likely to precipitate is a speeding up of trends that we already see in the world economy, particularly a sort of a cleaving or division of the world into two, one a China-led group and the other a US-led group. And it's in all likelihood that after the coronavirus lockdown ends, there will be an escalation in attempts to divide China from the US, particularly by Trump in the lead up to the election and beyond. And it's very clear that Biden and Trump are vying with each other to become more and more anti-China. What this basically means is that I think you will see two currency zones forming, but it's important to watch the yuan US dollar cross. That is going to become a key benchmark going forward. And it's likely, I would suggest, that China will form this group. It'll be an economic arrangement, but it will facilitate anybody in the China grouping to pool their dollars with China and be able to use that in crises if they need it. But the yuan will be used more and more within that grouping. And as I was saying yesterday in my Capital Wars talk, that broadly speaking, China now has to financialize its economy in a very hurried way, pretty much like Japan was doing from the early 1980s onwards. And that will facilitate the opening up of the capital account in China, the access to Chinese bond markets, the development of a digital currency, a digital yuan, and more particularly the invoicing of more trade in yuan and the development via Chinese banks of a yuan trade credit market. Finally, in terms of the main points that I'm going to go into, I want to talk respectively about fixed income markets, about inflation risk going forward, about what's going to happen to the dollar and gold, and then basically the outlook for equities. I mean, the extent of risk off, I beg your pardon, in the world economy right now would suggest that equities are going to outperform coming out of this. In terms of the global liquidity cycle on slide 3, you can see there the extent to which we're getting a V-shaped rebound in liquidity. That plainly had started before the coronavirus crisis, but it's being added to significantly since, and liquidity will keep going up. I'll demonstrate in coming slides. In terms of the transmission, this is our standard diagram. What you'll notice there is that there's typically about an 18-month lead time for liquidity onto the real economy. So this won't be an instantaneous relief, but it will basically feed through over around about an 18 to 20-month period in the normal sort of fashions. So the world economy is clearly going to stutter or be affected adversely for many months, but there'll be an initial quick rebound generally, as we're seeing now in Asia. Let me skip over this slide because it's something I've tackled before, but it's just about the structure of money markets, and focus on this slide, which is really highlighting what is still a big problem in the world economy. And it's something which is distorting financial markets and interest rates enormously. And this is basically the point which is highlighted on the right-hand chart, that there is a structural shortage of safe assets in the world economy. And because credit growth and liquidity is now rests very substantially on collateral and wholesale market behavior, these safe assets, such as 10-year treasury bonds or high quality collateral from the G10 economies, is really critical for credit creation. And that's the problem we've had really since GFC1. There's been a general lack of these assets, which is one of the reasons why liquidity has not been sufficiently adequate most of the time for markets. And you see these sudden lurches down in markets because there's an illiquidity problem. That is highlighted as well on the left-hand chart, which is a slightly wonkish interpretation, but it basically says that here is a measure of the US monetary stance, which is the Fed funds rate in red, and the yellow line is a measure of the term premia adjusted for inflation and volatility for the US bond market. And the yellow line there, the term premia, is supposed to be a demand for safe assets, and it should be compared to what the Fed funds rate is saying. In theory, these two lines should move together. when there is a gap like this, it's suggesting there is a structural shortage of safe assets, which is saying the demand for safe assets is not being fulfilled by the authorities either through the Treasury or through the Federal Reserve of Liquidity. What you'd expect to see if the Fed and the Treasury are successful in their current endeavors is the yellow line closing the gap with the red line. In other words, bond markets underperforming. Now, let me just take that one step further on slide 8, which is looking at two factors here. One is the 10-year US Treasury term premia itself, which is the left-hand chart. The gray areas are showing QE periods. One of the things to stress, which we continually stress in our research, is that is a major driver of term premia. Now, term premia, as it happens, are the major driver in turn of bond yields, particularly yields at the longer end of the market. And if you look at data that is published by the New York Federal Reserve, taking that as an independent benchmark, they come up with figures which would suggest that about 75% of the variation at the long end of the Treasury market is purely term premia effects. It's not to do with rate expectations. And this data basically confirms that by saying that during QE phases, the grey lines, what you nearly always see, or what you have always seen, I should say, is a rise in the term premia. And it's often quite meaningful. What you tend to see is at least 100 basis points upwards in term premia. And that would have a significant effect on Treasury yields were it to happen again. And it looks as if there is at least some impact coming on the Treasury market right now, if you look at the current grey area. The latest QE phase began with the Fed around September of last year. It lasted till around February, and now we've seen this big step up in what probably we should be calling QE6. That has had the effect already of starting to put a floor under term premium, and it looks as if it's starting to push them up. Now, how far could term premium go? Well, I drew this chart up, which looks at term premium in yellow here against the red line on the right, which is overall safe asset growth. Now, the theory here is that Treasury issuance, in other words, the amount of marketable debt that the US government issues, plus the size of the Federal Reserve balance sheet, should be a very good heads up to what the level of term premia are. And the reason being is that those two quantities, the Fed balance sheet and marketable debt, are a measure of the excess supply of Treasury debt. And the higher the excess supply, the higher the term premium. And what this chart is illustrating is that the recent endeavors of the Treasury and the Fed are basically starting to increase the supply of safe assets markedly. So we're moving out of the regime which says we've got a shortage of safe assets, and you can see evidence of a big pickup. Now, I haven't cheated on this chart, which begins around 1990. You can even draw this right back to the 1940s, and you get exactly the same relationship. One of the reasons why yield curve control, which is one of the fashionable concepts that people are talking about in the US market right now, is going to be difficult for the US authorities, is illustrated in these pie charts. And the last period of very successful, or the last period of yield curve control, which proved successful, was basically coming out of World War II. And there are a number of differences, and let me just cite two. One of them is that if you look at the supply of treasuries and the Fed balance sheet, my excess supply of safe assets in the earlier chart, in the period from end of World War II to the early 1950s, the so-called Treasury-Fed Accord in the US, when the bond market was eased up in 1951, that window of 5 or 6 years was a period where the Treasury controlled, or the Fed and the Treasury controlled the yield curve successfully. They put a cap on, or ceiling on long-term yields, and that worked. But Treasury issuance and the Fed balance sheet actually fell during that period. The Fed didn't have to buy very many treasuries, and new issuance collapsed. What's more, as these pie charts say, what you had is a very, very different structure of ownership. Look at the left-hand pies. In 1945, American domestic banks owned 41% of the treasury market. So it's very easy for the Federal Reserve to basically control that market. through moral suasion of the banks, foreigners own less than, well, about 1%. In 2019, foreigners' share is now 40%, and the banks are 4%. The Fed itself, which owned 1% in 1945 and could step up slightly its ownership, is now at 14%. So the ability of the Federal Reserve to actually control the market is a lot more difficult now. And then if you look at bank balance sheets, which is another test of this, which is the right-hand pies, you'll see that in 1945, the structure of banking was radically different. Banks, in terms of their asset base, had 62% of their assets in US treasuries and only 19% in loans. Now it's 58% in loans and only 4% in treasuries. So the picture is radically different. It's going to be very hard to do yield curve control. And the nearest we might get is to what you might draw the analogy with a dirty floating currencies, and that is a dirty yield curve control. It won't be effective. Already what you're seeing on slide 10 is a significant pickup in liquidity conditions, which we can see on both the left-hand chart, which is all central banks working. The Fed, again, which is the orange-yellow area, is leading. And we're also seeing signs that overall liquidity is picking up. It was already picking up through 2019, but it's starting to accelerate again now, and that's likely to be the measure going forward. Where is most of the liquidity going? Well, in terms of the flow, it's the US, Switzerland, emerging markets, which are at the top. China, very mysteriously, is not doing very much, as I'll come back to later. The UK has been slow. Japan hasn't really needed to, etc. And then in terms of momentum at the margin, relative to where we were over 6 months, emerging markets are starting to get quite an upward catapult of liquidity, that being largely in some of the Asian markets. In terms of what China is doing and other central banks, let me just highlight this. What you can see on the left-hand chart is latest data. So that is weekly changes. So what it tells us is that central bank balance sheets measured by the yellow line on the right-hand scale are growing at a rate of well over 60% at an annualized clip. The red line is our monthly liquidity index to show that that's pretty much shadowing what's going on. And it's very likely the red line is going to keep going up under central bank balance sheet expansion. The right-hand chart is pinpointing China. And this is the sort of enigma and the mystery and everything else that's going on right now. And I think what it tells us is that China are not having the same extensive problems that other economies are having in terms of financing. Every day, if you look at what PBOC operations are in the money markets, there's a statement which says liquidity perfectly adequate, no need to do anything. And that's been going on now for around 6 weeks. There have been 1 or 2 little tweaks, but nothing really of substance through that period. It's been flatlined. This is the longest period of inactivity I've seen from the People's Bank since they really began active open market operations in around late 2014. So this is a very unusual period. And what you can see from the chart on the right is there is some gradual step up in the size of the balance sheet on a 6-month annualized growth rate, but it's barely troubling, the needle here. And what you can see from the black and the orange lines, the orange being foreign exchange reserve holdings and the black being active domestic asset holdings by the PBOC, is that the period of change in China was late 2014, 2015, when foreign exchange reserves stopped growing. Up to that point, they'd been wholeheartedly monetized by the People's Bank with very little domestic asset movements itself. The black line was really a very small envelope on top of that, or margin on top of that. The black line or black area since 2015 has been very active. That's saying that PBOC watching is absolutely critical to understand here. It's the second most important central bank in the world. And what you're seeing latterly is really a flatlining of liquidity deliberately engineered by the PBOC. They've done this really through the period of both attempts to control the shadow banking system in 2018, through the period of trade negotiations with the US, the trade spat, and then latterly through the period of the coronavirus. And I would suspect that what is going on here is a deliberate targeting of the yuan, or at least attempts to make the yuan-US dollar cross stable, so China can come out of this and show to the world that it's actually got a stable financial system. Slide 13 is then looking through what is the Federal Reserve response. What I've done here is to detail each of the previous packages, starting from QE1 in November 2008, right through to what I currently call QE6, which is the latest endeavor. One of the themes of our research over the last decade has been to say that these QE processes are unending. We were never ever going to see QE1 alone. It was always going to be a series of these pills that have been popped by policymakers. And it's going to continue. There'll be a QE7, a QE8, etc. The world needs liquidity, and a world where you've got a collateralized credit creation process, central banks basically have to keep coming in to top the level of liquidity up. The size of this current QE6, as I've suggested there, is around 4 trillion. It will probably take the US Federal Reserve balance sheet to well over 8 trillion by the end of the year. The arithmetic that I've used to get there is maybe slightly heroic, but I've taken the already announced programs as of that date of 2 trillion, plus the additional 4.3 trillion of potential that was announced, open-ended programs, and I've assumed there'll be a 50% take-up. Now that clearly may not be correct. It may be a lot more than that. Overall, what it tells us is the Federal Reserve, I think, is determined to monetize about 70 to 80% of the Treasury debt issuance. So there'll be a lot of monetization going on. The other point to note is what's happened on the swap lines. It's kind of difficult to really get an honest benchmark of swap lines because swap lines vary over their tenor. You can do a 7-day, you can do a 84-day, etc. So what I've done here is just to do a rolling cumulative average, or total rather, of swap lines over a rolling 3-month window to show what's going on, to compare this with 2008, hopefully successfully, to see the scale and the alacrity with which the Fed has moved. And it's still going up, but you can see the scale of this. And these swap lines are critical. The important difference between now and 2008-9 is that the decision to give swap lines is a decision that was then in 2008-9 wholly in the gift of the Federal Reserve. It's now depends on who sits in the White House. So Trump has clearly had some input into the decisions, and the countries that are on the list who get swaps are America's friends, not surprisingly. What is the heat map of central bank liquidity looking? You can see there, that's what it's doing. The slightly orange tinge in the UK was because they were initially slow to go off the mark, but as of last week, they announced an open-ending financing of government spending through a so-called Ways and Means account at the Bank of England, which is just simply saying the Bank of England is going to write checks to the government. China, as we know, is not doing an awful lot. The Eurozone is not as fast as the US. Emerging markets are colored mainly because of what's happening in China, but you can see around that other countries are beginning to pick up. But the response has been unquestionably led by the US. And the fact that they moved with swap lines very quickly suggests to us that they do not want the dollar stronger. Liquidity, as you can see on this graph, is sort of picking up pretty much as you would expect. The right-hand chart is the more meaningful one to show that everything is going up at a pretty rapid speed. The left-hand one just says, look, America is leading this charge. What does it mean for economies and maybe world trade? Well, let me just make a couple of points about this. One is the chart on the left is looking at world PMIs, or business confidence indexes, in orange, and the red line is our liquidity index. The liquidity index, as always, is shifted forward by around about 9 months to show it's leading. The collapse in supply in the world economy has caused the orange area clearly to collapse down to levels of, on that index, about 20. It probably is around its floor point now, as we'll see in a few moments, but it's likely you'll get some rebound, sharp rebound initially, and the world economy should be recovering by the second half of the year. The volume of liquidity would tend to suggest that you've got the potential for a sharp recovery. The other point to note, which I think is an intriguing one in this context, is that if you look at shipping activity, which clearly has collapsed according to that yellow line, and maybe not surprisingly too, it may be seeing the early signs of a bounce coming through, as the uptick says for the March data. That was largely Asia coming back on track. And what you're seeing as well is cross-border flow activity holding up. Now, that's very much against the consensus belief and a lot of the, let me say, somewhat uninformed anecdote or assertions that you get in the media. And people have immediately jumped on the fact that capital flows are dropping away and there's a big exodus of money coming out of emerging markets. That doesn't really seem to be the case looking at our data. Admittedly, this is data up to the end of March, and so April may change that. But you have had portfolio outflows, unquestionably, from these economies. But also you've had big credit inflows. But the wholesale cross-border banking markets are working. The swap lines have been designed to actually ensure that's the case. And you're not getting the dislocations in wholesale banking that you saw in 2008-9. It's simply not happening. This is much more Now, let's see what that could mean for yield curves and bond markets. And here the news I don't think is particularly encouraging, because if you look at both the left and the right-hand charts here, what they illustrate is our liquidity indexes in red shifted on by 9 months in both cases. And on the left and on the right, respectively, you've got the G4 economies and then the US by itself on the right. Now, the scale of liquidity inflow that the markets are receiving should tell us that yield curves steepen by quite a lot. Now, the caveat clearly is to what extent yield curve control is successful. Well, it's only the US, well, I mean, admittedly, maybe from Australia and perhaps Japan, that are still doing it. But America has sort of hinted at that, but other countries are not. So there may be some success, but I'm very doubtful it will work. So I think that there is a lot of upward pressure coming at the longer end of the market, but we'll see over coming months. And term premia are really the thing to watch here. The other thing which bodes ill for the bond markets is this data, which is not liquidity data, but it's expectations data that we take from US business surveys. And the left-hand graph is collecting all the data from it goes up to the end of April, to 2 days ago. And it shows basically the surveys that come out of the US, such as the Michigan Consumer Survey and all the Federal Reserve regional surveys. And what it looks at is a comparison between current state of consumer and business expectations and their expectations 6 months out. And that is normally an extremely good heads up to what's happening to the yield curve. And the yellow line has been shifted forward by about 3 months. Now, what it illustrates to us is that there again is a lot of pressure on the yield curve, as you can see for the G4 shown in red. And that's concurring with the liquidity data. So if the Federal Reserve is very successful at yield curve control, well, okay, we'll come quietly, but we doubt that's the case. And there's got to be upward pressure on bond yields. Bonds are not the area to be in equally if you believe that governments are going to enact financial repression, which I would say are very, very high odds of that happening. The right-hand chart is looking at the US ISM index, in other words, the PMI, shown there in yellow, and the red line is interest rate expectations taken from the US term structure using latest data. And basically what it's looking at is how much the market expects yields to increase looking forward about a year. And this is basically saying that that red line, which is taking the change in expectations, a little bit like the left-hand graph for the economic expectations, this is interest rate expectations. Very good lead indicator of the US business cycle shown by the US ISM PMI survey. And that would suggest that we are going to get, quite a sharp rebound coming through for US economic activity, if this is correct. So again, all the odds are suggesting that there's going to be a cyclical rebound, and probably of some measure. Let me now turn to the US dollar, which is on slide 20, and let me look at what we think of the prospects there. In terms of understanding the dollar, we always look in detail at the mix of liquidity. The mix of liquidity is critical to the outlook for currencies. In other words, it's a quality argument. And what drives the currencies up are private sector liquidity flows, and what drives currencies down are central bank liquidity flows. Good liquidity and bad liquidity, if you like. The difference between the two, which you can graph, you can see it visually on the left-hand graph, which is showing US private sector liquidity in yellow and Fed in red. Private sector liquidity in the US has been pretty strong of late. There's been a lot of cash flow generation, and the banks have been coming through with more lending. That has been spurred upwards through March and will be in April too, before it likely collapses, as you saw back in 2009. Now, the episode in GFC1 is illustrative because what you can see going on in GFC1 back in 2008-9 is a very sharp spike in private sector liquidity. That was as corporations sought to generate cash quickly. They basically tried to bring down trade debtors. They drew down credit lines from banks, etc. And they got initial liquidity, also probably liquidating inventory, before the yellow line then collapsed as they got into recession and whatever. But the Federal Reserve liquidity line, the red line in 2008-9, stayed elevated through QE1, QE2, etc. And that's what is likely to happen this time. So what we've seen is the rapid catch-up of Fed liquidity, and you've seen the peak of US private sector. The difference between the two lines is then graphed as the Forex risk index labeled on the right-hand chart. And that basically is graphed alongside the trade-weighted dollar, the DXY, shown as a deviation from its 3-year trend. The reason for showing a deviation from trend rather than a year-on-year change is that we could be accused of cheating on a year-on-year change, as it doesn't show contemporaneous movements in currencies. This is a hard test of whether the Forex risk index leads, and what we've done here is we've pushed it on by around about 12 months. Indicator. And what this is basically telling us is we should be coming to an inflection point pretty soon in the US dollar. And I would suggest that's pretty much what the US authorities are seeking. If you look at the next page, this is emerging market currencies, and it's shown on the left-hand graph alongside the JP Morgan Emerging Market FX Index. Now, one of the things I want to stress here is that the fundamentals in emerging markets, despite the sell-off in currencies, are actually pretty good. And what you can see in terms of that red line is the Forex risk index of emerging economies taken relative to the US. Now, historically, that's a really good predictor of currency markets, and it's got most of the twists and turns in EM Forex markets over the medium term correctly spotted. So the red line has been a great lead indicator. And what it's been doing, what it seems to have done latterly, is that although that you can see coming into 2020 a little bit of a dip in the Forex risk index for EM, the overshoot in EM Forex has been so significant that you can see it departing markedly from that red line. The red line, however, is going up, and that's largely because of the US equivalent line is going down because of Fed easing, and the fact that many emerging market central banks, while they've eased, they've certainly not matched the same degree of ease that the Fed has seen. So what this is likely saying is that EM currencies should rebound and stabilize looking forward. Gold, the sort of perennial favorite of people that believe in liquidity, what this is showing is the impact of the Federal Reserve and the PBOC balance sheet together on the price of gold. This is again looking at the price of gold deviations from a 3-year trend, and what you've got is the Fed and PBOC balance sheet together in terms of an index shown on that left-hand graph. What it's indicating is the gold price is very well underpinned. If the Fed is instrumental in driving the gold price, we've also got to say that the People's Bank is too. China is clearly a big holder of gold. Gold is central to Asian culture, particularly Chinese culture. And if you start to see massive monetization in the world or in China, you will start to see the gold price going up. And that's what clearly is happening right now. Let me touch on the emerging market question just a little bit more. This is looking at capital flows up to March. March is just 1 month we know. There may have been a little bit of a dip, but you're not seeing the sort of plunges in capital flows that we've seen before. And that's, I think, important to stress again, because it would seem to suggest that what you've got is the wholesale markets or the whole markets working pretty well and credit being extended. So this doesn't look like the sort of liquidity black hole or the credit freeze or whatever one calls it, sudden stop that we saw in 2008, 2009. This is a heat map showing capital flows into various economies. You can see that, you know, some are, the US is obviously attracting money, the big economies are, but generally speaking, the picture for capital flow is not greatly disrupted, as you can see on the graph. Finally, let me turn to equity markets and say a few words about those. In terms of our thinking, what we do is we look at the flow of liquidity to understand the bond market and the shape of the economic cycle. We look at the mix of liquidity to understand what's happening in currencies, the quality mix as I indicated, and we look at the positioning of liquidity for equity markets. The chart on the left-hand side is looking at a mountainscape diagram which looks at the holdings of financial assets worldwide. In other words, liquid assets, equities, emerging markets, gold, etc. And one of the things that we found is that both globally and for individual countries, asset allocation is actually a very systematic process. And whether it's that investors follow a 60-40 equity bond split, or whether they follow an 80-20 safe asset, risk asset mix, whichever the country you look at, that tends to be stable. So there's a lot of mean reversion going on in asset allocation. And what we've done is we've taken the ratio between risk assets, in other words, equities and corporate debt, and safe assets, which are liquid assets and government bonds, that ratio of risk to safe assets, and we've graphed it as the red line on the right-hand graph as a normalized statistical series. And what that shows is that at marks -20 +20 is a 1 standard deviation difference, 40 is 2, and 60 is 3. And what you see is that this distribution on the red line has fat tails. It overshoots very often. And you can see with the yellow line on top of that, the yellow line is OECD economic growth. Now, what that chart is basically illustrating is that risk appetite, the risk on, risk off allocations of investors in red basically align with the business cycle, but there is overshooting, as I indicated. And that would suggest that unless we believe that this is, say, a major recession, but I mean a recession that is going to last more than a quarter or so, then maybe we've got to rethink the equity allocation. If you believe that we come out of this, I'm not going to say unscathed, but at least quickly through maybe 3 or 4 months, then the question start to look at equity markets again. One of the things I've said on earlier calls is that from an arithmetic or analytical point of view, if you look at a dividend discount model and you discount equity earnings for a traditional cyclical stock, only 14% of the value of the equity it can be attributed to the first 2 years' earnings. And for a growth stock, it's as little as 4%. So most of the value in the equity franchises are in the tails or in the future of the distribution of cash flows, not in the current. And that's just one of the joys or one of the facts of discounting forward a major franchise value. Now, clearly what that says is that why have markets sold off? It's because of liquidity concerns or default concerns. But as I've tried to say, those are largely arrested by what central banks have done. What would be interesting to do, as we try and show in slide 25, is to compare what's happened this time with GFC1. And what we've done is to compile on the left-hand side a nowcasting, which come from our friends at Nowcasting Economics. That is basically showing, or those charts on the left as showing a GDP momentum indicator for the world. So this is a daily plot of all ongoing data releases, and it tries to project what the current state of economies basically is. The charts on the right-hand side are our risk appetite indexes, and what they basically show is the positioning of investors on a daily basis between risk assets and safe assets. Now, the top two charts refer to GFC1, and the bottom two charts to what I've called GFC2, the current crisis. What you can see in GFC1 very clearly is that the world economy bottomed out around about the end of Q1 2009. It was beginning to pick up through Q2 very clearly, and that was a very progressive rebound. And if you look at risk appetite probably bottomed about 3 months before, and then showed a less steep incline, but it basically picked up. And the fact that the risk appetite saw this gradual progressive increase is really why equity markets have had this solid outperformance over several years. They did not sort of get back to scratch sort of immediately. It took them some time to discount going forward. Now, if you look at what's happening this time around, you can see that the shape of the distribution is very different. The world economy did not sink together. Asia, particularly China, sank first. So the big drop you see in the red line on that lower left-hand chart is the initial impact of China and the effect on Korea and Japan, and the Asian periphery basically began to be hurt through that initial period. China then began to rebound just at a time when the other economies worldwide, particularly Europe and America, started to sink. And that's why you see this sort of sharp sort of sawtooth pattern in the data. Although Asia is recovering, the weight of decline from the US and from Europe is still putting the index down. But you can see that it looks as if it's beginning to bottom out now. And that's important. If you look at the risk appetite index, it seems to be following a similar course to what we saw in GFC1. It's progressively bottoming and picking up. It might be intriguing to point out that although financial markets and equity markets notably have bounced by about 25% since the lows, there hasn't been a major amount of reallocation back into risk assets. This, remember, is a measure of equity, it's a measure of risk asset versus safe asset exposure. It's got price in it, but price is not the dominant factor. It's looking also at allocations. And so what this is saying is that the value of portfolios, including allocations, devoted to risk assets, hasn't really changed markedly. It's come out from the tail at the bottom of the sort of minus 80 worst point, but it's still at sort of minus 60-ish levels. Now, if you look at different economies, let me just highlight some of these features. The US has by far and away been the market that's been most clobbered in this coronavirus crisis, remarkably given the Fed's alacrity and size of move, but notwithstanding that's what's happened. So the tram lines on these charts basically show 2 standard deviation moves. Markets really, well, most of the time stay within that. There are periods of extreme, and those periods are extreme at the top is when you want to be removing equity exposure or risk asset exposure. And at the bottom, when it goes through the bottom line, you want to be taking it on. That's been a great rule of thumb historically over long periods of time, and it still applies in our view. You can see that the US, as I said, has been clobbered hard. That to a large extent was to do with the unwinding of these risk parity funds, these sort of leveraged vehicles that got hit hard in the sell-off. And a lot of US institutions who were in these funds went heavily back into bonds. And that's been one of the reasons that's driven US bond yields lower rapidly, and why this risk appetite index is so low. The Eurozone's low, but it's sort of starting to rebound, UK similarly, and Japan. Emerging markets are seeing a similar picture. China is a lot more robust, as you can see in the top left-hand chart. There hasn't been the same degree of sell-off. Russia is, obviously gyrating because of oil mostly, but you can see this pattern. One of the markets I wanted to highlight or some of these markets, but Korea hasn't had the same degree of sell-off in terms of risk appetite moves that the others have. Mexico equally, rather curiously, it was sort of down at these levels anyway. And the other one to point out is Turkey. Now, although it's not necessarily on everyone's radar screen, particularly in Asia, it's an important illustration of how this system works. Because if you go back to 2018, you will see that the Turkish red barometer of risk appetite plunged through the lower bound and went right down to -80. Now, a lot of people who were investing in Turkey and looking at Turkey were saying, whoa, this is the end of the world. You know, equities are never going to bounce back. There'll be dislocations in markets. This is really the end of any sensible investing. But actually, lo and behold, it proved to be a remarkably prescient time to buy. And if you'd have bought during those extremes, when this thing was down at -80, you'd have made a lot of money in the Turkish market. And that just goes to show that even when pessimism is huge and people argue there are structural changes, these indicators work because asset allocation has to follow a logical process, and the structure of the asset mix between equities, bonds, and other risk assets is a mean reverting structure. And this would basically say that equities looking forward are a decent place to be. So let me conclude, maybe just going right back to the beginning of where we were and say, look, what does this mean? What we're saying is probably to bring out the three most salient points. One is that you've got this massive increase in global liquidity and in central bank responses, but it's being led by the Fed. Secondly, that the Fed's actions are focusing very much, I think, on a medium-term view on creating this sort of quasi-economic NATO, or the equivalent of NATO, for this S15 group in countries, which will be critical going forward in terms of dollar usage. And the speed of the US move would tend to suggest they do not want the dollar to spike higher. They want a stable to lower dollar. And then finally, in terms of the asset arguments, what we've said is that we don't like bond markets, government bond markets in particular. Yield curve control may be tried, but I don't think it's going to work. It's too much of a burden for the Fed and the Treasury to enact this. They're just too small in the context of these flows now. I didn't mention inflation risk, but I will just mention something now about that. The degree of monetary growth that you're seeing makes us wary about the inflation outlook in late 2021. But one of the things that you've seen during past crises and even during periods of yield curve control before, back in the late 1940s, was that markets always respected monetary growth numbers. When monetary growth slowed down immediately after World War II, there was deflation. When monetary growth sped up in the early 50s, even through a yield curve control regime, inflation accelerated. You can't get away from the fact that if the US is seeing 20% plus monetary growth this year, particularly at the retail level, not the wholesale level, most of the growth in liquidity, remember, in the last 2 decades has been at the wholesale level. This is coming through at the retail level, at the level of the consumer and the small business. And they're going to spend the money. And that's why I think you've got this inflation risk coming forward. Monetary growth matters. 20% plus monetary growth against a background of low velocity, which we've already got, and trend economic growth, probably at best 2.5%, means that gap has got to be filled by price movements. It will be cyclical, it will be short-lived, but it may still be there. And that would suggest you want gold, you want to avoid bonds. The US dollar, we think, is topping out, and the level of risk aversion that currently we're seeing would suggest that equity markets will outperform over the next 6 to 12 months. Let me stop there and let me revert to the screen and see if there are some questions coming up, which we may have.
Yes, thank you very much, Michael. If anyone has any questions, then feel free to put them in the chat, and I'll patch you through for Michael to answer them. So if anyone has any questions, go ahead. don't think there are any questions.
Okay.
No. Okay. Yeah. Which
Thank
case,
you all.
yeah. Thank you very much to. Oh, we do
There's
have one
there's
question.
one here. Yeah.
Yep. There we go. From
Sorry.
Chen. Chen, I will patch you through now if that's okay.
Hi, Michael. This is Charan from
Hi.
Singapore. So, okay, thanks for the great presentation. So, may I know what's your view on Aussie and the Kiwi, and in particular, your view on this cross?
That is the New Zealand Aussie dollar cross. Let me. Okay. I think what I'll do is I'll answer that in two ways. One is a sort of general point, and the other is what I'll do is I'll come back and I'll look at our models because I haven't got those in front of me. But that's an interesting question. I think the key thing that we would tend to see is that if you look at those two countries or those two currencies, China tends to have a pretty big effect on New Zealand, and one would suspect that, you know, looking at the recent upheavals, the Aussie dollar has taken an undue hit because it's much more commodity related, and it has more bearing with the rest of the world. So I think that if you believe that the world economy is going to rebound looking forward, and it's going to follow maybe what China is doing now, you would expect to see that the Australian dollar will strengthen vis-a-vis the Kiwi dollar. So that would be my sense looking forward for a stronger Australian dollar. The Australian dollar's had, you know, a woeful time over the last 18 months or so, maybe even longer, but it deserves some sort of respite. And if you get a cyclical rebound on the world economy, which may well be the outlook here in terms of more infrastructure spending, etc., then that should be the case. But I will revert to you today or tomorrow with what our models are saying on that cross.
Oh, okay, thanks.
Thank you.
There was another question that has come in.
Yep, there's another one from Nicholas Ong. So I'm just going to patch it through now, Nicholas. Over to you.
Yes, I wanted to find out your view on commodities other than gold. Commodities such as oil, agricultural commodities, industrial metals, and so on.
Okay, let me try and tackle that. If you look at the commodity, the constellation of commodity prices, they tend to follow very closely the direction of gold. And if you look at a picture of the gold price versus other commodities, the lead time is about 9 months. Now, a large reason for that, or a major reason for that, is again the currency of denomination, the dollar, and that tends to be a major factor. But effectively, if you're getting monetary inflation, which is what we're seeing, price goes up and you start to see commodity prices moving. Now, one of the things to distinguish in all this, in looking at inflation measures, is the difference between what I just called monetary inflation, which is what central banks are doing with their currencies, trying to devalue their currencies or paper monies, and cost inflation, which is really coming out of the real economy and is more to do with productivity trends or underlying commodity costs, that differential. And I think what you're seeing is, first of all, a monetary inflation process underway, which is what the gold market's telling us, and that will also lift off other commodity prices. And then you've got the cost element to start to feed into that. Now, I think the cost element really rests on three particular considerations. One is what's happening to oil. That's geopolitics, and I would suspect that what you're likely to see is attempts to stabilize the oil market and the oil price to remain or to rebound probably into the level of around about the $40 to $50 area, and possibly higher. One of the things to remember is that the collapse in oil of late has not really been to do with anything more than the fact there's just no storage facilities left, and it's very difficult to turn the tap off of oil production. It becomes disruptive, so it's much better to keep pumping than not. So this is a temporary dislocation in the oil markets, and that will likely come through. On some of the softs and harder metals, I think you've got two things, broadly speaking, going on. One is that there clearly, both through this period and maybe in the lead up to it, has been a dearth of new projects, particularly in a lot of the metals. and you're seeing structural shortages in a number of areas, notably copper, looking forward. The other thing is that once you start to look at critical minerals and foodstuffs, what you're also seeing is attempts to hoard or redirect production for domestic use appearing through this crisis. And one of the things I think you've got looking forward is basically something which is a theme we've seen before, which is a scramble for resources, attempts to try and shore up those particular lines of supply. Now, I know anecdotally that the British government is trying to do exactly that, and they've got an initiative which they're currently rolling out, which is being sped up by the crisis, to say we need to secure long-term supply of critical minerals and foodstuffs and other supplies for the UK economy. Equally, you can take an anecdotal point, another one, to say that one of the things that came out of this crisis was that the US and the European governments realized that 80% of their healthcare supplies of drugs and materials actually was supplied either directly or indirectly by China. And this is trying to say we've got to source production more generally, and we've got to get those supply lines fixed. So I think that what that's going to tell us is that cost inflation in the commodity space also picks up. So I think that you will see both monetary inflation and cost inflation as you start to see governments, if you like, scramble to secure resources. And that, after all, is something that one normally sees in a period of heightened geopolitical tensions. It was very much the theme of the late 1930s, when you saw a sort of a similar attempts at dividing the world economy. Hopefully that helps. I think there was another question I saw come in from Vince.
Yes, we have another one here from Vince. Vince, I'm about to patch you through now. Over to you.
Thanks, Michael. Thanks for the excellent presentation. My concern is that the debt level, absolute debt level of governments are now so high that it put QE4 or QE5 into question whether it is going to be effective. How do you rate the chances of a global deflation simply because of the national level of debt has reached an unprecedented level, but notional interest rates, especially policy rate, cannot go much below 0%. So given this conflict, do you think that the world is heading towards a global deflation? Your central view is that the world can rebound given the sufficient liquidity injection and fiscal spending. But why are you so confident that the world can avoid a global deflation?
Okay, I think you're very good question, Vince. I think that what you've got to think about in terms of how these forces operate is to come back to what I just suggested in terms of looking at the difference between monetary inflation and inflation and cost deflation. Now, I think it sounds incompatible, but it's not, that you can simultaneously have a monetary inflation and a cost deflation. Okay, that could be very much the case. And I think what the world is seeing in terms of those factors is a structural cost deflation, notwithstanding what I just said about pockets of cost inflation in commodities, but structurally across most of world industry, because of excess capacity in a number of areas, because of the vast production potential of China, which is still got plenty of years to run, what you're seeing is a massive cost deflation. And that is compounded by the fact that technology is improving all the time, that demographics are aging, and it's causing structural cost deflation. Now, that's one of the things that we've lived with and we're living with. That isn't necessarily bad for economies. It's a fact, and you can basically see periods in world history where prices have fallen, but economies have boomed. The late 19th century was a very clear example of that. But I think you've then got to come back to the other point, which is, what about monetary inflation and monetary deflation? The gold price is a not bad, but a not fail-safe way of understanding monetary inflation. And one of the things that I would argue happened in the period following GFC1 is that central banks did not put enough liquidity in at the right times. And if you look at the gold market wasn't uniformly strong. In other words, for much of the last few years, the gold market has been actually very weak, which is suggesting that actually what you've had going on is a monetary deflation. There wasn't enough liquidity in the world, or if it was in the wrong places. And what we're seeing now is a huge monetary inflation. And if you get a monetary inflation, it's normally good for economic activity. Now, what you might say to me, I think not unreasonably, is, well, of course, surely we've had in the lead up to GFC2, as I call it, a very strong Wall Street. And so surely there was lots of liquidity in the US system. Well, the answer to that is yes and no. And I think one of the things that one's got to single out is that why was Wall Street such a strong outperformer vis-a-vis other markets? Because the MSCI ex the US has not been strong over the last few years, and emerging markets we know have languished. And that, I think, is testimony to the fact there hasn't been a lot of liquidity in the system. Now, why was the US special? Because what was going on was that there was the austerity drive and the lack of safe assets in the world economy. Now, if you've got a situation where regulators are saying time and again to banks and to insurance companies, you've got of safe assets you're holding, and most of them view US treasuries as the safest asset, and you've got large pools of what I call corporate institutional cash that are vying for these treasuries, these safe assets, there's a structural shortage. So what's happened in the US market is that not only has there been a huge demand for treasuries coming from foreign investors, but there's also been a gap which has been filled by corporate debt. Now, the rise in US corporate debt has been off the scales, and that's largely been opportunistic because it's been so cheap to issue debt. And what these corporations have done, as we know, is to issue massive amounts of debt to lever their balance sheets and to actually buy back equity. So the US has been a special case which has been caused by these austerity policies and lack of safe assets. And that may now be unwinding. So what I would suspect to see is a period where monetary inflation coincides with this structural cost deflation, but the monetary inflation is key for economies and for financial markets. I think that what that will mean is that we get a reasonably good rebound in economies. We've got to bear in mind that the world is not the same as it was 10, 20 years ago, and the growth rate of the world economy is structurally lower, but it's still not zero. And I still believe that with monetary impulse, you will get growth. And that will be underscored by more fiscal spending, particularly on infrastructure. The Chinese economy will continue to grow fast. And one of the things we've maintained is that history shows that planned economies like China can continue to grow at fast rates for decades until they stop. And the stop, as we saw in the Soviet Union, can be sudden. But up to that point, you still see a lot of growth. So I think the growth of meaningful levels is going to continue, and this rebound will be relatively fast. In terms of market outperformance, what does it tell us? I think it tells us that non-US markets will outperform, not least because I think the dollar is peaking, and the US market, after a sharp rebound, which may lead the world back, I think is then going to underperform. Hopefully that's a bit long-winded, but hopefully that answers the question.
Right. Well, I think that's all the questions.
Good. General,
yes.
Thank you.
Yeah. Well, should we wrap it up there then?
Very good. Thanks for your time, everybody.
Yeah, thank you very much, everybody. Thank you very much to Michael again for another installment. I will be posting this on YouTube and sending out a link to this as well. Michael has also released a new book entitled Capital Wars. I will also send everyone a link to that. Well, thank you very much once again, and have a good rest of your day.
Thanks so much.
Thank you. Bye.